Corporate Governance vis-à-vis Companies Act 2013. The moderator of the present session is Professor Mrinmoy, Sharma, Department of Business Administration, and our resource persons for this session are CA Sunil Sharma sir and Shri Vijay Kapur sir. We will now like to request Professor Mrinmoy Sharma sir, Department of Business Administration, CA Sunil Sharma sir, and Shri Vijay Kapur sir, Director Board of Studies, Institute of Chartered Accountants. Shri Vijay Kapur sir. Sunil Sharma.
Dignitaries, respected persons, Sarmaji and Kapurji, it's a proud privilege for me to moderate this session. In fact, even though Resma was introducing or ranked me as an expert, I'm not an expert in these areas at all. And this is my just the duty to conduct these sessions. And I have nothing to moderate. In fact, Kapur Sahab, entrailed us for so many minutes. In fact, how many minutes I couldn't recall it. Like 45 minutes or so. Even though he wanted an extension, maybe a few minutes, apart from 15 minutes.
My few minutes are.
Yes, that's it.
I would have a few minutes.
So. Everybody is eagerly waiting to listen to him once again, more technical detail, and also Sarmaji, CA Sunil Sharma will also discuss on these areas. And because, as I said, I am not an expert in Companies Act, neither on corporate governance, but I have taken a cue from yesterday or a little bit before that, when Professor told me that you will have to moderate. Corporate governance, for that matter, as Vice Chancellor was referring to as a good corporate governance, is a huge affair. And examples Kapurji mentioning in the morning in a universal session, examples of Sectum, examples of Enron, all this happened because of not so good governance, greed, or something else. We have seen Sahara is also in a dock. We have seen Rose Valley, we have seen Sarda scam. All these politicians are also in trouble. This is what is happening because of the problem of governance. The Companies Act, like they have made compulsory 4 committees, and they have tried to put in electronic media that we have been taking a rusted 956. Even though the award was objected upon by Kapurji, directors can communicate in a video conference also. So I will be listening to all these things in this session and the sessions that are going to follow in today and tomorrow. But apart from all this enactment, we must be very, very sure about the thing that laws are always there. Our CRPC is one of the strongest in the world. The steel murders are happening, rapes are happening, all. Or how to implement these things. What is our intention? Whether we should really get away from our crimes, from our greed, from the offences, or really we should be ethical enough. We must have, as Kapurji was mentioning in the morning, we should have a lot of integrity. These are the questions to be answered. But this workshop, I will be dealing with the nitty-gritties of the acts, as well as we'll also get to hear, I'm patiently waiting to hear about the ethical aspects of this corporate governance, because this session is specifically on corporate governance and Companies Act. So therefore, I ask our research persons, these aspects also. Act is there, no problem. Anybody can read the act and find out what is there and what is not to be there. But how to implement it? And also I would request them to narrate some cases, definitely with respect to 1950 what led to the changes to 2013? In fact, 2013 was, as was mentioned in the morning, that it was pending, from 2008, maybe during 1956 to 2008, there were certain things that came up, apart from the technology things, which really needed the change in Companies Act. With these introductory words, I'm afraid that initially it was mentioned that 1 hour would be allotted to the resource persons. And I know we are eagerly waiting for that 1 hour. Had it been 1.5 hours also, we've been waiting and listening patiently. But then we'll have to have a lunch break at 1:30. So I'll respect to my request my respected resource person to try to finish in 50 minutes, so that we've got some time for interaction, and ask all the participants to ask questions. If you have got any confusion, please ask, because these are the persons you are not going to get every day. You will get people like me who will not be able to answer any of your questions. Right? So, as far as this is concerned, not other parts. As company, yeah, he is sitting there. The experienced person, Sharma is sitting here. So ask questions. May not be related to only Companies Act. Maybe some of you are interested in doing your CA. Commerce students specifically. How do you? I'll give you 1-2 minutes, no problem about that. Only 7%. Sharma sir was only telling that it was increased this year. Last year it's only 7% of the examination. Examination passed chartered accountancy. Why? Why not 100%? What is the problem? Do they ask them? Do they screen intentionally that no, itna sara CA nahi hona chahiye, hamara pet mein tala lag jayega? Is it like that? Or is there some merit? What are the things they look at? Try to understand this also. Not entire session should be devoted to this kind of things. Right? Main questions should be on Companies Act, but also a few other sub-questions should be on these areas if you are really interested. With these remarks, I request first, who is interested in come first, sir? Sarma, yes. Because we are probably, I actually get some, race to Kapur also. I'll invite Sarma to deliver his, address and speech and enlighten all of us. Thank you very much.
Academicians, student present here. A very good morning to all of you. It's morning. A lot of rules and regulations in place, but our mechanism for monitoring and controlling these regulations is weak, because there are not right kind of persons sitting there to regulate and moderate these acts. Our economy is opening up. We are heading toward globalizations. Global corporations are coming to India, and Indian companies are taking over foreign companies. They are becoming multinationals. They are becoming global entities. So we stand at a platform where we can match all other global entities. We match the standards, global standards, and our practices are treated as best practices. And we are at it. We conducted by an institution in Singapore as well as ACCT. India ranks 4th among corporate governance implementation. USA, UK, Singapore. These are the other 3 countries. Other big countries like Russia, Brazil, South Africa, China, these rank below India. So that way there is a spike that we are improving. We are not that bad. Before coming to the main discussion, I'll put some facts about our economy. Basically, everybody understands what is a company. Yes. Everybody understands. It's an artificial person, it's a legal person, created by human endeavors. Shareholders contribute resources for a common cause, and a legal entity comes into being, which is governed by human beings again. Though legally it is identified as a separate entity, but it is governed by human beings. So there will be conflict of interest. The person who is managing will have his own interest, and and there will be interest of the corporate. So what is needed is balance between these two, which is called governance. So once it comes in the control of company, it becomes corporate governance. So we'll be discussing that particular part of corporate governance in the initial talk. Then I'll come to the specifics of Companies Act 2013. So when a company comes to being, the administration or the promoter is there, shareholders are there, and to manage the company there is a management which comprises of board of directors and executives. Then there are employees and workers, and they provide service to the various facets of the society, which include ultimate consumer. Government is also one of the stakeholders. Then there are financial institutions, like there are many entities. So these are the basic background of what corporate governance is. So I'll come to the specifics of the theoretical part. Practices, processes by which company is directed and controlled, done by its memorandum article of association. That is the constitution of the company, and that again is regulated by Companies Act. So whatever given is a memorandum article of association is specific to the company, but the Companies Act is an umbrella which covers all corporates. So your bylaws has to be at tune with the Companies Act. If that goes against the Companies Act, Companies Act prevails. So any act done beyond the Companies Act, that is treated as ultra vires. So the companies involve balancing the interest of various stakeholders. The stakeholders are the management, shareholder, consumers, suppliers, financier, governments, and the community at large. So how to balance these? What is the sole purpose of company? Wealth creation. Protecting the wealth and increasing the value of shares and shareholders' wealth. That is the primary objective of any company. Nobody comes for charity. For charity, there are different organizations. Then they serve the society. So once they give something to society, they owe something to society. Like if a plant comes up, it causes damages to the environment. So it has to take up some steps to give back to the environment. Similarly, once a company comes up in an area, it generates a lot of employment in that area. So because of that, the overall economic of that particular area changes, which you can witness very well in the recent times in Assam. When the Nimligarh refinery came up, we have this Brahmaputra cracker coming up. There are different industries coming up in the towns. So those towns have come up only because of this particular entity which has come up there. So you can very well imagine the contribution, how one company can change the scenario. Because of that, how many different facets of the societies are gained and affected. So when there is an effect of the society, we have to take active step. So that falls under the ambit of corporate governance. Now, why governance? As I spoke earlier that we are heading toward globalization and all foreign companies are coming to India, we are going abroad. So there is international deregulation of the financial markets. FIIs can invest in India, foreign companies can take over Indian companies, we can take over foreign companies. So we said we need some good regulations so that these can be done smoothly and there is no undue advantage taken by any of the entities. The scale of the working has grown up many folds. The corporates are growing. You heard billions, trillions, 1,000 crore, 1 lakh crore, 10 lakh crore. That kind of figure is coming. So it is a huge figure. So to manage these kind of huge figures, it's natural human tendency of greed. There will be person sitting in the executives or management. They will try their best how to get a part of it. Maybe I'm in a supply department, I'll have interaction with the suppliers. I may try to get an advantage. That is unethical. So corporate governance requires an ethical behavior of the management. There is a growth of institutional investors. Sorry for that. There is growth of institutional investors. There are big financial institutions, there are mutual funds, there are foreign institutional investors. They invest hugely in the companies. So once they invest in companies, they will look that the money they put in the companies has to be safe, because the money they bring in belongs to some other person. And dividend, company may pay dividend or not. Like other day I was looking at the figures of Infosys. Somebody who invested at the initial stage of Infosys in 100 shares, today his worth will be 141 crores. So that kind of wealth creation can be there from investment in shares. So that is not a small figure. Doing a business and having a wealth of 141 crores, it's a big ask. But because of the functioning of an corporate in a very methodical way, very open, transparent way, they have generated that kind of wealth for the persons who have invested in that corporate. So that is the good example of governance. In India, we have the best example for governance is Tata's. Tata company is looked at as professionally managed. I will share one data with you. That is a study by KPMG. It's a big consulting company, global company. They have carried out a research in India. They have come out with an estimated figure that 95% of listed companies in India and almost 42% of unlisted, 42 million, let's say, 42 million of unlisted companies are family-owned companies. So what are family-owned companies? Basically, when we speak of Birla, Tata is not a family-owned company because they have a separate entities. A trust fund is there, which Tata Sons is there, which owns the main company. But there are many companies. The most prominent comes is Birlas, Ambani's, Ruyas. They have their family stake in the company. They are the promoter of the company. And they hold a large chunk of the shareholding in the company, plus they own the management also. So once you have your own stake in the company, plus you manage the company, there will be conflict of interest and there will be a vested interest. So in India, we have this typical scenario where the family-owned company are rampant. Professionally managed company are very few. Those which are professionally managed, they are managed well, either they survive or they go for winding up. But family companies, they are rugged. We had a spread of recession in last 1.5 decade, but Indian economy thankfully was not very badly affected because it was managed well. We didn't have too much of exposure of international transactions. Then there is out and you can change the market capitalization. Then it is of the size of 75% of GDP. And it employs 57% of our India's totally employable population. So are we alone where the family-owned companies are there? No. It is a global phenomenon. Around 4 days or 5 days back, there was a big article in Economic Times as well as Times of India. It says presently around 98% of the world's capital is held by 1% of the total population of the globe. And in the near future, by 2020, there will be owning 90, not from 98, they will be owning 99 point some odd percentage of the global capital. So the rich are growing richer and poorer are getting poorer. But there is a hefty middle class which contributes to the growth of such corporations by contributing to all the corporation as a stakeholder. The other study which I was wanting to share with you about the family-owned companies, that is relating to USA. In USA also you have family-owned companies. Not only the professional companies are there, there are family-owned companies. So a study was carried out by Harvard University. They had a sample size of 24 companies, big 24 listed companies, out of which 12 were family-owned companies. So major chunk of American companies are also family-owned companies. So once family-owned company comes, the whatever rules, regulations which are there, they remain in books. Because vested, their personal interest comes before the corporate interest. So to regulate these kind of interest, government is always striving hard to bring them to the books, but to catch a thief you have to be thief. Government is always reactive, it is not proactive. Our all laws are borrowed from either USA or UK. Recent times we are copying from USA, but all our earlier laws, all are borrowed from United Kingdom. Even our Companies Act, which is one of the largest piece of legislation on earth, the 1956 one, that is borrowed from Britishers. We have improved it, we have made it to our situation. It was almost 6 decades old now, so we have replaced it by the 13 Act. Prior to that, we have tried twice to replace it, but we couldn't do it. So even this time, it is half-hearted attempt. Those of you who follow this 2013, it is coming in bits and pieces. Earlier 98 sections were announced, then part were announced from 1st April. Even now, there are many sections which are gone by 1956. So we are at the juncture where you have to know both the companies in 1956 as well as 2013. There are certain areas which is gone by 56, there are certain areas which is gone by 2013, and whole set of rules and regulation and notification, like Kapur sir was telling you how many changes have gone in last 1 year. So with this kind of fickleness of the government, it is very difficult to make a decision. Suppose a client comes to me to take an advice. What should I advise? Because I myself is not clear that what the law will take, when the law will change, because all the policies are future oriented. It is not planned for present. It is all future oriented. When future is not decisive and regulation is changing rapidly, you cannot plan. So how the company is there? You have, they are the entities, they are the persons who run the entire company. So they are the principal under whom the company is revolving. And lenders, the banks which lend you money to run the business, then there are creditors who supply you goods, then there are employees who earn their livelihood from the company, then there are, government is there, government is expecting a revenue from the company, and it wants that once a corporation has come up, it has given an employment, it should survive and sustain that employment so that it contributes to the economy. Then there is management and board of directors. They are interested that company grows, the wealth of the company grows, the wealth of all the stakeholders grows. Because once you are associated with a good entity, the results are good, the vibes are good, everybody grows. So, like our parents used to say, be in good company. Your friend should be good. Wherever you go and come, it should be good. Don't keep bad friends. So, similarly, here also the stakeholders, they feel that they should be in good hands. So, the management has to take all the responsibility for all these other parts. England and USA, Singapore. So, these are various codes they have announced in course of the time. You can see right from 92, 95, 98, 99, 2002, the process is evolving. It has a new concept. Then in 2002, Enron happened, Wordell happened. So the US economy was shaken for a moment. The investor confidence went haywire. So they put this Sarbanes-Oxley Act, SOX. So when SOX was there, we had also thought that we should do also something. So after that, there has been rapid development. Mostly all the practices of corporate governance is based on OECD, Organization of Economic Cooperation and Development. This is a organization of the global countries which strive for common issues. So they have given the principles. So all the basic corporate governance, ethics and the details, rules, regulations are all based on OECD principles. Perspective, we had companies at 1956, but on governance part it was basically only compliance part to the government, filing returns and giving details to the government. But to the shareholders and to the other parties, what was to be given was very limited. The information couldn't give you the inside of the company. So once these kind of things happened, that point before 2002, Harshanada took place and second Parikh was inputting. We had a Nareshchandra committee which was specifically given a purpose for improving the reporting requirements. So they have recommended requirements for financial and non-financial aspect to be reported. So they have prescribed that director's report should be given in each and every audit report, where the given some criteria what are to. Then some financial changes are reported that in accounts, notes to the accounts, you give various details what are to be given there. So the reader of the account can make out that these are the basic details, because these are consolidated figures of the company. So just by looking at the numbers, you don't get the insights that what is actually happening. So some recommendation came, and these were implemented in 2002. So that Companies Act has taken a significant lead, and they have brought this into part of Act. Act and rules, they incorporate all these details. Other part are Securities and Contract Regulation Act 1956, which is designed basically to protect the investors, how the money is to be brought to the company, so long the money is not used, how it is to be kept in banks and when to be returned. These are basically domain of the Securities Contract Regulation Act. Then there is SEBI. SEBI Act 1992 came. Then SEBI came up with clause 49, which is the listing requirement, which are the listed companies. They have to enter into an agreement with the stock exchange. SEBI has recommended a agreement where the clause 49 particularly dealt with the corporate governance issue. So this clause 49 is a very important aspect. Like it runs parallel to the Companies Act. The many issues which are there in clause 49 are also there in Companies Act 2013, but on certain points they differ. I'll come to the various initiatives taken under the Companies Act 2013. I'll touch upon these issues briefly. Just I'll give the precursor of these because after this session there are 3 more sessions to go, today and tomorrow. There some of the issues will be discussed in detail. So what is I speak now in detail will be repeated again in that session. So what I'll do is basically give you the hint of the particular domain so that you get more details in that particular session, and if you have any queries you can ask that time with more details. So basically the Companies Act 2013, it tries to regulate these 6 parts. One is director and management. In this field they have made drastic changes. They have touched upon the auditors because it was felt that auditors are not reporting properly. The report which the details should go there, they are not disclosing the reports in the reports, all the details. So from auditor's point of view, they have become little harsh. Then reporting framework is what they have to give in the director's report, and other reports they have to come out periodically to the public in large, to the government, to the other stakeholders. Those are covered under reporting framework. Then another step is restructuring. New one, section 149 is there. Whatever I deal now will be only limited to listed companies. Public companies, you have listed company, non-listed company. Then there is small company, one-man company. So I'll be limiting myself to the public companies having their shares listed on the any of the stock exchange. So has to be in India for 102 days or more. Like there are companies where all the directors are residing abroad. So So when the board is sitting outside, you cannot get hold of them. If something goes wrong, so you have to negotiate with that country and repatriate to them to country, and the country may not cooperate. So now they have come with this thing that one of the director has to be in India at least for 182 days. On the board of listed companies, they have prescribed a size under the rules. There has to be one lady director. That's maintained for independent directors. So you can do that and get yourself enrolled in that registry. So the corporates which require women director will have an opportunity to sit in the boards. Now the new concept of independent director has come up. A board constitutes minimum of 2 directors and maximum of 15. So at least 1/3 of the listed company has to be independent directors. There has to be an audit committee. There has to be a nomination and nomination committee. These were not there. Audit committee was brought in the Companies Act by an amendment in 2000, but it was not applicable to all kind of companies. But now it has come to companies, all listed companies. Now the independent directors have come up to instill the confidence of the investors and to tell the world that no, it is not managed by the persons who own the company or who promoted the company. There are persons from outside who are sitting in the board and who are running. So once somebody from outside is there, he's deemed that he will be impartial. He'll take all the benefit of all the stakeholders. He'll not concentrate only on the promoters and the top management. So independent directors have come to the parade. So for independent directors, there is a separate code of governance. So there is Schedule 4 to the Companies Act, which lays down various guidelines, rules, regulations, qualifications, who can be an independent director, what things he can do, what he cannot do. Those are given in Schedule 4. So you can minimum term of 5 years for an independent director, who can be a director for another 5 years, but he cannot continue beyond that 5 years. There has to be a cool-off period of 3 years, then again he can come in the board. So there is a cap that you cannot be a perpetual director. Once you have entered the company, you can stay there for long. This retirement clause is not applicable. Once they have been elected to the board for 5 years, they will be there for 5 years. They are not liable for certain acts. What are there? It's given that they are not liable for, they are liable only to the acts and knowledge and attributes brought by the board possessed with his consent or convenience or not having acted diligently. If he is negligent or he has acted mollified, collusing with the existing directors with the knowledge that this thing is going to happen and this will bring loss to the company or distribute to the company, he is treated as negligent. Otherwise, he is not treated as a negligent director. To the employees' ESOPs. So they are not entitled to those ESOPs. They are only entitled to sitting fees and they can get certain commission relating to the profits. Nothing beyond that. For that there is separate regulation that is given in Schedule 4, which lays out the details that how you can claim certain commission and what kind of entitlement you will have for sitting fees. Independent have to hold annual meeting where no other non-independent director or key managerial person or senior management. This is a drastic change. All the independent directors, whether 2, 3, 4, what are there in the company, they will have a meeting every year among themselves. No other directors will be there in that meeting. They will view the working of the other directors. They will view the working of the top management, and they'll formulate a policy and they'll prepare a report that will be circulated. There has to be an audit committee. So audit committee consists of 3 directors, minimum 3 directors, majority should be independent director. The chairperson and majority of the committee members should have ability to read and understand financial statements. So if somebody from a background which is where he doesn't understand numbers or where he cannot read the financial statement, it not deserved at the audit committee. Audit committee, the man should be from the financial background, who understands the numbers and who can make out what is there inside the numbers. So what responsibilities are there? They have to recommend appointment, decide remuneration of the auditors, monitor the independence and effectiveness of the committee as well as the auditors, examine the financial statement and auditors report thereon. The financial statement first goes to the audit committee, they'll examine, they'll give their report on that. Then it is placed in board of meeting, board approves those accounts, it goes to the auditor, auditor does his part, then sends back to the company for its comment. After that it is passed in the meeting, then it is placed in general meeting. So in general meeting the members, after discussing the accounts, they pass the accounts, then it is treated as adopted. How the controls are there, which are there in companies for managing the finances, are in control or not, they'll have to analyze and evaluate. And what risk the failures on the control part will generate, they'll have to come up with solution and monitoring process. So again, under that part, there is the reporting part. Reporting, the directors has to ensure that proper system ensure proper compliance with all applicable laws in India. That system is operative correctly. Means one of the key point of the corporate governance is that compliance with the local laws. All laws which are applicable to the entity, the corporate, are being followed or not. That is the responsibility of the directors to see, and they have specifically in their directors report that these are followed. And they have to make a declaration in that report that they have taken proper and sufficient care for maintenance of adequate accounting records, for safeguarding assets and preventing and detecting fraud and other irregularities. This declaration is very important because if these books are not there, confidence among the stakeholders that the systems are in place and these are being followed. It's not working. Internal financial controls have been laid down and these are being followed effectively. Not only that statement is made, they have to give a declaration in that. And the manner in which the performance evaluation of board member have been conducted. Like the committee will evaluate the performance of each and every board member. So they have to give out in the report how the evaluation has been done, what has been the criteria for evaluation and where one stands. If any of you have gone to the earlier reports, in the director's report they give the details of which director is holding what post, what committees he is participating, how many meetings were there, how many meetings he attended. So these kind of reports give you detail that the person is functioning or not. The person whom responsibility is given is actually responsible or irresponsible. They have changed the definition of subsidiary, associate, joint venture company that is given in section 26 and 287. Now basically subsidiary is one which where the company controls 50% or more of share capital or exercise control over the board. Means the majority of the board of directors are common in both the companies. Associate is one where 20% of total share capital is owned by the holding company or the sister associate concern, and the business decisions are done under some agreement. For all the companies, the financial year has to be regular, whether the holding and subsidiary, if you have two different years, then the accounts will give different dates. Suppose I am ending my years on 31st of December. My holding company is closing accounts on 31st of March. So there is a gap of 3 months. So the result may be distorted. Within 3 months, many things can happen. So now the entities have to have a uniform financial year. There is exemption given for the having different financial year. That is given spelled out here that if a holding subsidiary company incorporated outside India and it is required to follow a different financial year as per the law of that country, then it can follow. And otherwise, for the corporate and associates as well as for joint venture companies, there has been change in the depreciation requirement. Earlier, the accounts were prepared as per Schedule 6 and depreciation was followed by Schedule 14. Now, as per the new regime, the depreciation is to be provided. Depreciation is to be provided as per Schedule 2, and the concept of usual life of asset. Earlier, the depreciation was given irrespective of the life of the asset. You could have charged a little more depreciation, giving a rationale. But now there is a lifespan given for each kind of asset. Based on the lifespan or lifespan decided by a valuer of particular asset, depreciation is to be provided. So there is a drastic change in the depreciation regime. So it has to be followed by from the next year, that is the accounts which are ending on 31st March 15, and according to that you have to draw your accounts. I'll go rapidly because I have been instructed by the moderator to sum up my talk. So
We are so sorry, but
I'm also sorry because I couldn't go that rapidly.
I am very happy.
It was not mandatory. It was optional. You could go for internal audit or may not go for internal audit. Now, internal audit is a mandatory part by which the review is done on periodical basis. So, any error or any mistake or any fraud is there, that is detected at appropriate time and remedial measure can be taken. So, it's a very drastic step and very bold step which is taken. It's needed essentially for all the corporate for good governance. Next. Earlier it was not mandatory, now it is mandatory. This auditor who has gone out of the company cannot keep himself associated in any way with other entities by way of consultant or other advisor or become a partner in other entity. If he becomes a partner in other entity and that entity is doing audit of this company, they are this and that, they cannot do audit. So the basic purpose of this is the familiarity with the company of one person should come out, should be done away. He should not become a part of the company. Yes. So the new report, they have to qualify these. The most important is the last one, that if there is any money which is lying for the investors, whether that has been deposited in Investor Education and Protection (IEF), whether that has been placed or not. Other are related to the similar what directors have to report. Those are there. So I'll rush through these. Now the big task is reporting on fraud. Audit services to the company, and there is what sir was telling about new body has come up, NAFRA. So they will become regulator of the auditor. So long the institute was the regulatory body, now with institute the NAFRA has also come, they will monitor the activity of the auditors. The auditors have to undergo peer review. Other auditor checks the work of auditor. So that kind of system has come in place to instill the confidence of the investors. It's in section 234, merger of Indian company with a foreign company or foreign company with an Indian company. This particular section deals with that. Then there's a that can be merged with the fast track if the companies are small companies. The holding company wholly owns the subsidiary company, that can be merged. And they will prescribe the list of the companies. The list is updated, like the server selling everything is prescribed, 300 places or more to be prescribed, so it is to be prescribed. Before merging, declaration of solvency is to be submitted, that is again to be audited by chartered accountant, and that is to be given to all the concerned regulatory bodies. Then consent required from members of 90% of total number of shares, and majority of creditors. They have taken care of creditors, because creditors may be defrauded. Companies name is changed, companies merged, there is no company to whom to sue. Suddenly the company is vanished. So the creditors' consent is required for 90% or more. The concept of reduction of share capital had come into the Companies Act previously, I think in 2000, it's a correct school. So they have incorporated reduction of capital in a more detailed manner in this particular Companies Act 2013. So multiple buyback is not permitted, like in 1 year you can have only one buyback from the shareholders. You can give offer to shareholders, buy their shares back. Then one of the major steps taken for investor protection is related party transactions. Earlier simply you have to report in the auditor's report by way of not what transactions have been taken with the relatives. The relatives are defined in the Act. So the transactions which were there with relatives, those are to be quantified, and the balance outstanding at the close of the year, that was to be stated there. Now here they have taken a step further. All the transactions are subject to vetting. The arm's length transactions means the transactions which you will have with other parties, whether you are having the same with the related parties or not. Otherwise, you will be passing benefit to your related parties. I am selling something at 110 rupees to others. To relatives, I will give you at 102 rupees. That cannot be done. It has to be arm's length. So there are methods of arm's length calculations. According to that, you have to judge whether the transaction is at arm's length price or not. Board approval is required when transactions are done, and a special legislation is required. Then the parties which is interested, and there is a lacuna in the drafting. The related parties means all related parties, they cannot participate in it. Like other in listing requirement, only the interested party cannot vote, but here none of the related parties can vote. So this section particularly lies next. Knowledge, they operate in the stock market, or they take advantage of that information and make unlawful gain. So to curb that insider trading, the rules have come up. The law prescribes 125, 191, 195 section. So there is a huge penalty for that. That runs up to 25 crore rupees. Now for CSR, there has to be reporting. So in the board report, they have to take these details. These are to be reported in the board's practice report. And how it is to be administered, that is also laid out in the Act. So if you don't follow these, then company can be levied fine from 50,000 to 25 lakh rupees, and the officer who is in default can be penalized for 50,000 to 25 lakh rupees, or he may be imprisoned for 3 years. So that is basic details about the new Companies Act, which has taken care of the areas which brings about good governance, which brings about transparency in the transactions, which instill the faith of the investors as well as the persons who deal with the company. So that in totality go to instill the confidence of the entire society on the corporation, and that becomes a good governance. So with that, I conclude my presentation, and if you have any queries after Kapur sir speaks, we can discuss those. Thank you for your patient listening.
And it is in such a detail that I hope that the students have gained a lot of information. Right? Now I request Kapur sir to come up and share his rich experiences.
Be very brief.
लेकिन one request is there that सबका पेट का सवाल उनका ऊपर है. So I hope he will understand. And what I will do, I will request the coordinator to devote a certain time towards the end of the day or middle of the day.
Sir, I am department.
कौन सा semester में?
Sir, first semester. Sir, my question to you, which had somewhere sections around 650 to 420, and schedules were there. Now they are 7. And sir, you said, but still both of these acts simultaneously. That we are using some part of this act.
Racial NCLT 2000 amendment bill, which actually could not get through, could not succeed through. So, National Company Law Tribunals is a question. In fact, let me tell you that they wanted some kind of wherein administrative bureaucrats will come into. They could not do that. It is meant for the Supreme Court bench. When the Supreme Court bench NCLT, then in that case, rest of the section. No, 2013 Act, there is a provision impinging upon the formation of NCLT. Constitutional issues have been raised on that issue. What will come with composition of NCLT? So that before the Supreme Court. Because of that, they could not implement the rest of it. Okay. Now, having said that, I was seeing question we live in a society. You need to understand very clearly. Very clearly. 1956 Act was there. In fact, the 1940 UK Companies Act. Then there has been 1960, 65, 74, 88. These are the Vijay amendments. And I always tell my chartered accountant friends, every time there is more duties of the auditors. Or in taking a trust on the auditors, and there is more trust on the they say we cannot find the frauds. It's not. So the question is that when this Act 60 and 65 Act was amended, if you go to the history, you will find which done a lot of times of India Group, and your Visa man, Vijay Patnaik. They are responsible for all changes in the 1956 Act. I always say sun rises in the east. Now, how the things change, according to me, the technology and the insight, we need one book. Very, he's moved to the US president, that he used to be accurately dressed. Walking, movement, and I think you see his fellow who started from ICAI declared that $180 million cash is behind the bars. Put him behind the bars. That as soon as he comes out of his messages of any company, I criticize people, even paid least any like a techie who joins for the first year probably will get $60,000 per annum. Whatever he gets. Sanjay did all this, and you will be surprised to know that they actually correlate many laws of each. And you know how many telephones? They all travel first class. There's a business class in here. There's a first class in here. He became the approver of the SEC. These people travel from his, and he used to have 30 the iPhone 6, but the iPhone 6 has tracks so many tires. It will take 10 minutes for you to reach to this place. So you have to, and the students of commerce and management, according to this technology, from the commerce and management viewpoint, innovation in respect of ATMs, automatic teller machines. There can't be anything. As a teacher in commerce, I always think that today all this, in fact, there will be third-party ATMs. It's an ATM. You may have your account in any one of the banks. Going to that, I think where the banks would go. ATMs are to tender everything. You can just innovation. That's on this. So there is a presentation. I will make some points. My presentation, so you can ask questions. The presentation is going to be as crisp as possible because I am speak from 5 minutes to 5 hours and make my point. To come shareholders, the term is controlling shareholders. Shareholders better things at stake to ensure and better. It is in our own interest. They try to. So, and moreover, I think let's understand it very clearly. As you grow and see the companies there, it is conformity with law is on one thing. But simply if I try to prof form, I'm going to end nowhere. If I bring that structure into play, I'm not come to exist for charity, you know. As a student of economics, I think you have to get into Milton Friedman. It is available free. Authority are good about it to contribute, but it nothing beyond the contribution. First, we exist for the shareholders. To talk about corporate governance, a company is required to perform. Making profits, then in that case whom they are going to serve. So these things need to be understood. So on the first slide you will, of course, this aspect is taken care of. So I don't want to say recent technology. The only thing the first slide see that there has 49. In fact, I think some gentleman asked me a tea break. This is what happened to which came as a result of Enron failure, we incorporated more or less in our structure. That was in 2006. Narayan Murthy report, when Narayan Murthy report contained all shades of Sarma oscillate to clause 49. So everything. So we have the best, you know. In fact, that is how I say that in our case it is not revolutionary, it is revolutionary, you know. So now 2013, in fact, we go big. The wonderful things in the 2013 Companies Act itself, 2009, we have created many first in the world to understand whether they first in the CSR. In fact, they will appreciate that there was something called as Companies Auditor which came in 75, was revised twice. There's a company 2003. Professor Sarkar, my request to you will be that at least management graduate students, they should be given a copy of annual report. They at least should read through what is written in the board report. Why board is writing that? What kind of picture is being in their report? What things are to be given compulsory in their board report? How is it connected to the auditor's report? What is there in that report? You know, we need to understand and capture that. It is going to, from a governance viewpoint, I think the best of the thing which will happen is the director, women director, independent director, that we will deal a little bit. E-voting on proposals. Technology is being used to the. I do not know how actually effectively it is happening, but e-voting is a wonderful, you know. I am sure this, what you call it as a, I am not actually advocate to that much of certain provision, but statements that is linked with the introduction of Indias. Indias versus IFRS. I think you need to have a, in fact, the next year or somewhere they should have a full length session on the Indias. You need to understand what it is all about. Which actually change every time and every moment the way, you know. I can only give you one instance of the Indias or what is parallel with the IFRS. So today our figures given in the balance sheet are based on the cost, whatever the amount. I pay the money, I record the cost. I pay the transaction, you know, acquire the asset. In IFRS value or the India, what will happen? Say I bought a painting, auction. I pay 10 lakhs rupees for it. Second bidder for was 7.5 lakhs. When I record that painting in my books of account, I will book a loss of 2.5 lakhs in the profit and book the painting at 7.5 lakhs, you know. Value which is commanding in the market, you know. So I will not book my asset as 10 lakhs which I have paid, but I will book a loss of 2 for it. You know. The whole thing changes. The point is that we are trying through this IFRS, we are trying to make things more, you know, so that user in any part of the world wherever it stands, the figures are actually true and as well as relevant. We will just look at it, some of the concepts which I am going to say. So one is stakeholder concept. Yeah. Okay. So this is the broad agenda, and I am sure that I will speak to the question. can tell you if you attend our session, between the lowest employee and highest paid employee in the company, the difference people study. Why there is so much of a difference, even how many money from the company. That's one of the issues. I say that ask it in other way. How much is the executive compensation paid? How much money goes to the CS? I say forget about this. This was not required. Tata have, see, even Birlas, they have always adopted. They have given something for the education, something for done. This on the statute book. Now these 3 slides show that the only question which I need to ask, that CSR is sustainability is definitely a better term than the philanthropy or other. In the philanthropy, I can simply write it and give it. I will see how it is being done even now, can be done even now. The first question is that why it has been restricted over loss-making companies. A loss-making company, a Reliance loss-making company throughout their lives, They are the company which brought in minimum tax. They were so wonderfully well. You must understand it very clearly. Whenever they will see a profit comes up, they will buy assets. They will take a loan. Interest, the cost of the assets. Institute will say interest with the cost of the asset is not. No, we have taken the legal opinion. So they will capitalize the cost of the assets and hence the cost of the asset. Right depreciation without it's a law tells you even if you for a single day, you write depreciation for the whole year. No tax. So no tax company, wonderful, Making company, you don't have to invest anything, put in anything. You do not know why it is contingent upon the profit. For God's sake, the government should not try to tell us in which activity I have to put my money. Whether I do it in my nearby area, whether I do it for water, whether I do it for why the government should tell us that these activities I should. The third point which I always ask is that all has done so much of a thing that why it should only say 2%? Why not more than 2%? Where is the logic for all this? This is trying to make certain rules, The more interesting thing issue than this Finance Act 2014 made it clear that spending on CSR is not part of your business activity. It is an application of income. It's not a charge on the profit. I only need to ask the person who is sitting in front row. I always ask this question. I'm asking my taxation people also. Otherwise, so you tell me one thing, if I contribute money, I say as a company I don't have to do anything, business out of it. Large firms are very active, how they will get out of it. I say as a company I donate to the Prime Minister, national, can anybody stop me getting the, cannot. So anyway I get that business, I'm a foolish fellow if I'm doing all this. The government has given us a lot of money. Even if you ask ICAI, they will also give you money. ICAI, they have given, ICAI, they have given, NIRC, they have given, Vedanta is giving a lot of money for education. You can pick up a fund from that. They are spending their CS for students. So, question is that the way it is, see, if I am doing my business, allow me as a business expense, if I am even contributing to the society, why should not be allowed? Here, that certain bill of the amount. So CSR is a good thing, but to pushing it to a certain extent it is alright, but the law should have been much more fair. The board's role, stakeholder, I am talking is stakeholder. See, CSR is nothing but a stakeholder. This I have put the line in full, and I will ask, I wish the Vice Chancellor Sahib should have been there. Now imagine what's this 160. Imagine if I am sitting in the board of a company, I must act in a good faith to promote the objects of the company for the benefit of the members as a whole. And in the best interests of the company, members as a whole and the company are different. Its employees, shareholders, please understand, that means members are different, shareholders are different. Members are different, shareholders are different. member. Please understand. Yes. Company is a different. Company is a different than the members. Members own the company, you know. Shareholders are different. Its employees, its shareholders, and for the protection of the environment. I'm running a company for the community. When I take a decision, I put up an effluent plant, or I throw a chemical somewhere. If I start taking all these decisions, we should not harm my employee, we should not also harm my shareholder, we should only benefit shareholder, I must also take. How will I take the decisions? You know? It's a wonderful section which has been put. So, but it comprises all the stakeholders into it. You know? So as a board, I have to think out and imagine. I'm sure that the board will speak much. The way the board meetings are held. It's interesting to be seen how the audit committee meeting will see the board meeting, half an hour. The agenda will be given one day ago, 300 pages. Nobody on the earth can read it. So they will carry that agenda. If you look at the shareholders' right, in fact one very interesting provision, I think some commerce management students need to pyramid layering of the company has been banned. Today, if you say that if you read the Ketan Parekh scan, there were 280 related entities. Small this, small this, small this. Somehow the funds where are coming, nobody can know. We call it as diversion and tunneling of the funds. You know, the company funds will be diverted to another company. 280 companies, web of companies. Nobody knows what is happening. New Act very clearly, categorically states there cannot be more than 2 layers of investment companies. You know, I do not know how our regulators are going to manage. As per the article in the Economist, it should be there are about 86 companies of Reliance, which are related companies like this, and majority, some of these companies, they don't have any registered address. Their address is only email, so we don't know where they are located. They are simply located in the virtual world. They are something named as the Kankhal investments, which is quoted in an Economist article. You know, I'll give you that date. Kankhal is a place, you know, we are going to immerse our, you know, that fathers have old ashes. It's in North India, it's a place near Haridwar, you know. Kankhal is a place where we are going to immerse the ashes. It's a wonderful name, you know, thought out by the last people. So in the name of that immersion, they take everything, you know. So they control everything, you know. Intelligent people, you know. Business people are very intelligent. So Kankhal is the name which appealed to me. You know, how they actually thought of this name. So somebody must have gone to immerse the ashes, say Kankhal investments. Money comes. So they make money. Another very interesting thing is there, very interesting thing, 173, that today they say that if any decision is being taken, the one independent director must be there. Bring him for some, why one independent director only? Why not the majority of the independent directors? So such provisions are introduced with the hope, and very important thing, the related part, etc., that no interested shareholders can vote on the transactions in which they are interested, so other people will vote. Of course, the next is restrictions on the board. Restrictions on the board is there that they will not have any cash transactions, inside transactions, forward. This is something independent directors relating. In this, you have to actually see 2 or 3 things. Most of the professionals used to be the independent directors, particularly lawyers and chartered accountants. They will do some kind of work for that company. Under the new law, it has been completely prohibited, so no pecuniary relationship. That is one. The second thing is that in the new act, which should have been actually part of the rules or with the SEBI, a definition of fit and proper. Negative affirmations have also been brought in the act. He should be fit and proper. Negative, he should have the positive, these qualities. This is all forming part of the independent directors, 149, 2, 3, 4. There is also a requirement that independent directors will evaluate the board and board will evaluate the independent directors. Now, after evaluation of the board, fellow wants to throw independent directors, they can't go back to the shareholders. So it's a very, very interesting process. I think I missed a point on related parties. Maybe that was in the last slide. In the related parties, I will actually tell you one thing. Today, in fact, there is a provision that boards approval, audit committees, everything it is there. Special resolution had to be passed under the 2013. Companies Amendment 2014 says that the bill is cleared by the Lok Sabha, that instead of special resolution, it will be done by the ordinary resolution. But people are really finding it very, very difficult. On these questions, I will not speak because Sharma has dealt in detail. There is going to be a special session by our gentleman who is coming from. I would like to ask question. You ask question. Nokia phone. I said this company is going to the greatest of the greatest. Where is Nokia today? BlackBerry is going to be finished. Imagine a company. That company will run on governance. That company will run on innovations and technology. You need people in the independent directors or the directors on their board who can guide and innovate them for the future. If company like Nokia, I never thought in my imagination Nokia would disappear. Nokia disappears from this earth. What governance we are talking? What this technology, innovation, the things are going to make a change. If people who are sitting in the board do not think of it, just see around you how the companies are changing their tracks. I was talking to my friend yesterday evening why Reliance share is not rising. Why Reliance share is not rising? Everybody will say, he says Infosys is rising and making, but where is the Reliance thing stuck up? Not last 6 months. According to that study, they say that in fact that their composition of enhancing boards, that you can't, as an independent director, you cannot serve more than 2 terms of 5 years each. Good or bad, I can give you both contrasting examples. One example is that in Reliance, they say that on an average, a director has been serving from the last 14 years continuously. On the other hand, there is a provision, I can talk it openly, and I always, in Reserve Bank of India, there was a gentleman who is on the board of RBI board from last 20 years. RBI retired that gentleman as a director after 18 years, gave him the farewell. Some other professional chartered accountant was put. RBI went back to the government, please sir, we want the old man back. Shri Manega. He was given farewell by the board. But after 6 months they said, we want Shri Manega back. People may question. So experience cannot be also substituted. So when we try to have the rule book procedures combined with this kind of principles, they always make a clash. So it's very difficult to come to various conclusions. Any question? I will keep.
He stopped his lecture at 1:30 exactly. I watched the mobile, and then he's a man of word, in fact.
Sarma, Sarma, because he will save my life.
Sir, Devojit Dev and I am from Integrated MCOM program from 2nd SEM. So my question is, can 2 partnership firms create a company with a limited liability?
Are not recognized as person legally. So minimum 2 shareholders are required to form a company. Since both the partnerships are not persons, they cannot form a company. So you have to be an individual to form a company.
I have a question. See, there are certain corporations like Z Group running Kizzy and Apollo Hospitals running hospital chains. So when they invest in their respective endeavors, like in education or in health, do that constitute CSR activity? And what are the Companies Act norms, particularly 2013, for such kind of aspects?
Please sit down.
In our country, Sir has also mentioned that many people listen to Mr. Ahmadi not because he is a corporate leader, but because he is powerful. Moreover, the new government is liberalizing the FII and FDA policies. So, in sir, I want to know how this corporate act can help in protecting the interests of small and the indigenous companies.
When I was presenting my slides, I had to rush through because of constraint of time. There have been specific law has been made for investor protection as well as reporting. Until unless the corporate reports, how the individual shareholder will come to know what is happening in the company. suppose today what Reliance is doing, how do we know what it is doing? Nobody knows. Only the management knows. So the Act requires that management shares the information with the stakeholders. So the stakeholders can take a concise decision whether to stay with that company or not. So that is one of the mode. Second, they have taken step is for the investor protection, like minority shareholders. Majority of the shareholders are being held by the company or their subsidiary companies or group companies. So the small portion which is floating in the market or which is in the hands of the individuals, how that is to be protected. Like sir was telling, of the Fortune 500 companies, many are missing. And even in India, in 90s, there was a spread of those checks and balances are placed in the Companies Act. Now we will have to see how much they are functioning. These are at a nascent stage. We have learned from the mistakes. So how those mistakes are to be corrected. These are reactive. These are not proactive actions. So these reactive actions will prevent us from the known methods of fraud. If a new concise method of fraud comes up, which the government has not thought of or the regulators have not thought of, every other person will be defrauded.
So we are
Rural speech, I think I did make one remark that there is some kind of a situation in the new act where we have tried to put many governance provisions even for the public companies which are not listed. In fact, throughout the world, in fact, it's a very, then I had made a comment that maybe for good, because what is happening is that for our Companies Act has actually said that apart from the listed companies, a non-listed company, as even our VC said that in so much 100 crores and have to have these kind of a thing. So certain things have been brought down from listed companies to the non-listed companies. There are certain things which are applicable for the purely private companies. I am sure that we are going too far. We are traveling too far. But why private companies are being covered? I gave an example of Pataka Biri. Of course, Pataka Biri is not even a company. It is a firm. Now, if I am running that kind of a company, Coke, etc., if I am borrowing so heavily from the banking system, 100 crores, 200 crores and 500 crores, and if I am running a private company, if I remain out of the ambit of many governance provisions, I am going to create a ruckus in the market, That was the point. This is on that basis, 2013 extends this provision to the non-listed and the private companies to a very large extent. That in the private company, they should also be independent. In the private, see, question is, if purely a private company run by two people, husband, wife and children, they are on the board of directors, they cannot pass any resolution. There will be there will be only relatives and relatives and relatives, Of course, on the relatives, you also need to know that definitions given in the Companies Act are inconsistent with the definition given in the accounting standards. We have got a very strong accounting standard on related parties, and definition given in the Ind AS is a different, So, in fact, according to one definition, Rahul Gandhi and Robert Mugabe are not related to each other. And somewhere in the foreign country, you do not know my son, I don't know whose children, how they are become related, and who knows whose son is under what, son and father don't talk to each other. So all those problems are there. So we take your point that in fact that is why in the taxation we build up scheme that we pay one time presumptive tax and forget about it. It's a better way to do these things. Certain things must be, because otherwise our MSME sector will get a great hit. If you see the number of corporates in this, there will be about say 12 lakhs, 30 lakhs, somebody stated the number in the morning. 9 lakh, 10 lakh, 1 million will be the private limited companies. About 80,000 are the public limited companies. Only 6,000 are the 8,000 are the public listed. After some time, nobody will be able to discuss the law. There will be only rules, there will be only notification, there will be only circulars. Where it will go and how they will comply with everything, it's also a very difficult proposition. Laws should be made simple. In fact, and should be made simple for the smaller companies to run their business in an efficient manner, which is not happening under this law. So there has to be, and I know Modi government also must be have been under pressure. In fact, they have not also applied their mind fully to it. In fact, there has to be a complete task force to be set up to review the entire provision, take another 1 or 2 years, and bring out a law which is consistent and harmonious with other provisions of the various statute books. If you don't try to harmonize, you are going to be in trouble every time. Okay.
Sir, Sir, I have a question for Sunil Sharma, sir.
Yeah.
Sir, you mentioned that the rich class is becoming richer and the poor class is getting poorer. So my question is, can this act be kind of a good act in bringing inclusive growth, in uplifting particularly the middle section of the society?
No, like you cannot take this act to and it lays down the regulations by which the board has to work so that interest of all the parties is protected. So that is the idea of bringing the change. So maybe if everything goes by the ideas which are being planned now, maybe the small shareholders will benefit, their wealth will increase, the corporate will be in a better shape, so the ultimate beneficiary will be the shareholder. Not everybody will be beneficiary.
Raghunandan, you are on a wrong track. A good company track record who is invest very good amount in CSR, having the clean driven technology, their shares have gone down. I will give you the name of the company. Jan Irrigation Systems Limited. Drip irrigation they do. And there is a wonderful article which appeared in Harvard Business Review on the Jan irrigation only. They're technically that they are doing the best thing in the sustainability of the environment. I bought that share at 120, today it is 67 rupees. So that's not the index. Here you make money where people shake hands. You don't know where people shake hands. So this is not the index. You can't drive. In fact, nobody has been, if you see the empirical research on the stock prices, if you see that analysis being done for the 30, 40 years together, or the La Porta studies, whatever has been done, I can quote all those studies, that index, the stock market index is not reflective of all these things. It happens something else nobody knows. It only Junjunwala knows how it happens.
I'm a businessman from Tezpur. My question is, correct me if I'm wrong, like limited liability partnerships which were introduced in UK in year 2000, it was introduced due to many litigations were filed against law firms and CF accounting firms in UK in that period. So it was introduced to safeguard those interests, the partnerships, to limit the liability of the partners. But in India, when it was introduced in 2008 with the Act, it is introduced with all the business firms and everybody. Don't you think it can be misused in, it has been misused or it can be misused?
But it is basically used by consulting firms and professionals. In India, there is no such cap. Anybody can float a LLP, and the main quality of LLP is that only designated director who have unlimited liability. All other partners have limited liability. So it can be used by anybody. So if you say about misuse, anything can be misused. If you design something to defraud the revenue or defraud the administration or regulation, a concise effort cannot be checked. If I have a plan which other doesn't know and I implement that by which I make money and come out of the system, only after doing that the system will come to know. So if something happens of that sort, some check and balances will come in way to protect the LLP part. But so far LLP is not very popular in India.
But there is no check part of LLPs, I think, in India.
LLP again is being regulated like companies are being regulated. So register of companies there who is in charge of the compliance part. You have to file documents like in partnership. Everything is personal. Nobody knows what his partnership is doing. I can only tell to the sales tax department, I only tell to the income tax department what is my revenue. Others don't know anything about it. But LLP, my documents are in public domain. Nothing has come out that show. That which indicates.
Of 1956. Is there any such kind of provision in 2013 Act?
No, for LLP,
they had given reference to 1956 Act in LLP.
Yes. So since when LLP was formed, the Act was formed, 1956 Act was there. Now it will be replaced by 2013, so automatically all 1956 will become. So whatever provision there is in 2013, that will, in respect to the LLPs, it will apply. Like you can convert a LLP to the partnership or vice versa. That is possible. So many of the smaller companies, because of the compliance cost and the reporting which is to be done, they are converting to LLPs. So that process they are taking.
Really sorry that I have to leave Sarmaji and Kapurji. But then one last question we have time for. No, for ladies, from ladies.
So myself, Shri, a research scholar from Business Administration Department. So my question is, what is the role of Investor Education and Protection Fund in this Companies Act? What are the provision and what are the role that is mentioned? Well, in the presentation we have come across this Investor Education and Protection Fund. I just want to know the role of it. IEPF.
Lot of money. Lot of money. And in fact, even the Ministry of Corporate Affairs do not know how to spend it. I am telling you, it can't be spent. We at the institute conduct about 3,000 programs in 365 days. For which again we are given 10,000 rupees by the ministry. We spend 10,000 rupees more on it, doesn't matter. Lot of money, but still people don't understand how to work. So Investor Education Protection Fund is the money, the dividend which are actually blocked and not paid, and there's some certain thing, will got credit to that thing, So that fund has been there to protect the interest that like you conduct these funds and do all this research and something more if you wish to add.
So basically, like nowadays they have started giving ad on the TV. NSE, National Stock Exchange, and other mutual funds, they have started giving ad on the TV, making the investors aware that where to invest, where not to invest, what to be seen when you invest. So this is the basic aim of Investor Awareness Fund, but it is not actually being used in that way. It is spent on seminars where the person who knows about investing, they come, they listen to talk of the few persons like us, and they go back.
No,
but it is meant for general masses. It is to be stand on general masses who want to be investors.
I will request the branch to conduct one program on investor awareness here next time.
Yeah, sure.
That should be done. See, question is, I tell you, today the level of awareness is so low, because of the Google, you download everything. You don't upload anything. That's the problem. So level of awareness is very, very low. Actually, nobody knows what is happening. So people like me who can't search on Google, we retain whatever is there. That is also an advantage.
You will upload this video.
Sir, one minute. I would have gone there. In fact, as a teacher, I go amongst the crowd. See, I will only say, you are young students, I always advise, because since 4 years, I am out of actually academic field. I am actually out of academic field. I have become obsolete as far as accounting and auditing is concerned, sir. I only talk motivational to my students throughout the country, I can't talk anything else in the gathering of 3,000, 4,000 students. I always say there is one word in the dictionary, procrastination. Never postpone doing things. Do whatever you have to do today. Don't think of it. Don't sleep till 10 o'clock even on Sunday. Never. If you have to get up at 7, you have to get up at 7 every day. Never postpone doing things. Then you have to understand 3 things never return in life. 1, opportunity. Whenever an opportunity comes to listen to me, to attend the program, you have to actually decide, what should I do? But once having lost an opportunity, never regret. Move further. The second thing which never returns in life is the words which we utter. If you say any harsh words, it shall never return to our life. So always be careful. Choose your words very carefully. The third thing is the time, which never returns, Utilize your time in the best manner, Don't waste away your time. In fact, yesterday I was talking to Professor Sarkar. I was carrying that week magazine with me. There is a cover article on the YOLO, the word which I heard last week only, YOLO. You only live once. You only live once. I must utilize the time in the best possible manner. I must enjoy my life. I must love the work, whatever I do. Because I was telling him in 3 Idiots, the fellow wants to become a wildlife photographer. See, maybe by pushing, I have to get an MBA, I have to wear a coat, I have to, hell with that, boy. I'll go and sleep at the beach. Who can stop me? I'll only catch the fish. I want to do that. The life only comes once, So first of all, I think you must have respect for your parents. So I say that if by force you are doing anything, first of all, do only things whatever you love. If you don't have any option, then love whatever you are doing, if you want to survive, You have to understand it very clearly, So you have to have a pride. You have to have a pride in your work. You have to have a passion for your work, I will close my talk with one of the sentences which I read. I was reading the fallout of Enron. I was reading that article in the Journal of Accountancy. many years ago. Professor, it was written by Professor William Carmichael. One of his students was working at Enron. He said, I wrote a letter to my student, dear student, you are working at Enron, how are you feeling now? He said, that student of mine wrote back to me that, sir, lessons learnt in the difficult times are the lessons best learnt, you know. We must live up to that principle.
Moderator or any chairman in any seminar, he doesn't contribute anything but disturbs others from contributing things. Kapurji, excuse me. Sharmaji, excuse me. But then if we delay here, it will be delayed for the whole day, and maybe tomorrow also we are going to delay. But my returns and my request to my students stands there. Please do not hesitate to write down your and deposit it to Sarkar sir. And sir is going to stay back. Sarma sir is also going to stay back today. Yes, yes. And we'll have to find out time for these discussions, maybe after 5 o'clock when we finish all our sessions. So do not lose our opportunities, do not come again. But as he says, if you lose it, do not regret, but this time you should have to regret. You will have to regret if you do not write your questions and listen to the answers. With this, I'll request the formal vote of thanks. It will take half a second probably.